Hi, welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in financial markets for this week and beyond. Today is Tuesday, June 10th, and joining us on the call today are Bill Hall, Mike Larson, Doug Davenport, and Larry McMillan. All right, good morning, everyone, and welcome to the Squawk Call. We've got, certainly some interesting developments, new highs in the S&P 500 and the Dow last week, and again, to start off this week. A couple of stories in Bloomberg, kind of interesting. One, that MetLife has announced a $1 billion share buyback, which kind of goes to the point that, Bill Hall, you've been making a lot, that really the growth we've seen in the stock market over the past 12 months has a lot more to do with an expansion of the PE ratio because we're not getting any organic sales or earnings growth. In fact, what earnings growth I think we have gotten, 3 or 4%, is probably come because of all the share buybacks we're seeing more than anything else. What do you think?
I couldn't agree more with you because the large multinational companies have loads of cash on their balance sheets and they have to do something with the cash. So the choice is to dividend it, buy the stock back, reinvest in themselves, which is very expensive, and by reinvesting in themselves I mean going out and buying new property, plant, and equipment, hiring new people, or number 3, buying other companies. And so far, the primary choice has either been to buy back their own stock or to make acquisitions as opposed to reinvesting in themselves or paying out dividends. And one of the reasons companies are reluctant to pay out dividends is because in the U.S., and this does not happen in Europe, and this is strictly a U.S. cultural phenomenon, is that corporate CEOs and corporate boards of directors believe that a dividend is a contract with the shareholders that they can't retrace, meaning once you've established a dividend at a certain level, you only want to increase it. You do not want to reduce it because that indicates there's something wrong in your underlying business. So that's the primary reason that companies are reluctant to increase dividends, or when they do increase them, there's a great deal of thought that goes into that decision.
So the interesting thing I think about this, though, is the fact we've seen very slow earnings growth for years here, for the last couple of years. And, you find it pointing out that really all the gains we've seen in the S&P 500 over the last, say, 2.5 years have come from an expansion in the valuation multiples. So my question to you is, we've got corporate profit margins near an all-time high. Valuations are not, expensive, but they're certainly getting stretched. And how much longer can stocks keep gaining at a robust levels without any fundamental sales or earnings growth?
Well, Mike, that's a great question. My high school English teacher told me not to rely on quotes of others to make a point, but I will violate that rule and invoke what John Maynard Keynes has said, and people who've listened to my podcast or listened to me in the past know that I use this one a lot, and that's markets can remain irrational a lot longer than investors can remain patient. So obviously this can't go on forever. Sooner or later we're going to have to get some new earnings growth. I just don't know when, and I just don't see any signs of, I see signs, but I don't see any significant sign of a market breakdown just yet. We saw PE multiples go much, much higher in 1999. With the internet bubble. That doesn't mean that's a good thing. That doesn't mean I like it. As I've said, being a successful investor is not choosing what I particularly like in the news or what I find particularly appealing to me. What makes a good investor is somebody who's able to just stand back and take all the information in and make a realistic assessment. I think this is a dangerous market. I think it ends very badly. I just don't think it ends very badly just yet.
Okay, well said. Mike Larson, how about you? There's an interesting story that I'll throw your way from Bloomberg. It talks about the big bond mismatch. Supply of bonds worldwide will fall $460 billion short of demand this year. Maybe that's why interest rates have been going down and bonds have been going up in price this year. There's not enough supply out there. What do you think?
Yeah, very interesting if you'll pardon the pun story I know we were talking about. And I found something even more interesting, some research on just how low bond yields truly are, particularly in Europe. There's a great piece out by Deutsche Bank saying that basically the French 10-year government bond yield just fell to the lowest level since at least 1746. In Spain, we're talking about yields that haven't been lower since 1789. And in Italy, where data goes back to about 1808, the only lower period was right after at the tail end of World War II in 1945, which is also where U.S. mortgage rates hit their all-time low prior to a year and a half ago. So, bottom line, the headline of my piece is going to be they're partying like it's 1786 or 1746, and I think that kind of just speaks to how out of whack and how abnormal the interest rate markets are here. I mean, and it's not just the interest rate markets. I mean, there's a great piece in the Financial Times talking about the sound of silence, from currencies to bonds to stocks to commodities. Volatility gauges are at either all-time lows or only slightly above the levels they hit in late 06, early 07, which of course was the peak of the last stupid money, easy money fueled bubble. Across the board, you can see this sort of supreme confidence in central bankers to fix everything. I don't know. If that doesn't make you nervous, then I don't know what does. I mean, it's very much like the environment in the late 90s when Alan Greenspan was the maestro and everything was, and we had the Committee to Save the World on the cover of Time magazine, Alan Greenspan and Larry Summers and so on. It's kind of a crazy environment to be investing in. But again, as we mentioned earlier on the call, you don't know when it pops until it does. So it's kind of hard to try and lean against that. I mean, if you've been short, you've been run over, and you don't know when things are going to turn. But, color me the most nervous I've been about the markets, or getting to the point where I'm the most nervous I've been about the markets since 2007. And that's saying something. I mean, back then, we were warning with incredible alacrity and volume that the housing bust and the credit bust was not going to be contained. It was going to be an epic disaster, and plug your ears when people like Hank Paulson and Ben Bernanke say everything's going to be fine because they don't know what the heck they're talking about. I'm really starting to get more and more nervous about this environment, and I have to think that you can, as we've been doing in Safe Money Report, we've been investing in select highly rated stocks that are in powerful sector bull markets, things like domestic energy, aerospace, healthcare. I hate to beat a dead horse, but those types of sectors, those stocks have great Weiss ratings in there, have delivered very strong profits. I mean, single digit, nice double digit, almost 100% profits on one position in 7 or 8 months. But you got to be a more nervous bull here, I think, in some sectors, and I've started looking at ways to lean against the market finally after a long period of time of riding along with it. Because again, I don't know. Call me crazy, but yields at 268-year lows just don't sound all that attractive to me.
Come on, the lowest yield since the French and Indian Wars? What could go wrong? What could go wrong with that scenario?
I wasn't swapping stories with George Washington, when he became president in 1789, and I wasn't eating crepes with Robespierre before he got executed a few years later in France in the Revolution. But, I think it's fair to say that this kind of extreme complacency just is a little bit out of whack with the potential surprises you can get in the market. So I think that we got to be a little bit more cautious here. So that's kind of my big picture view. And, to drill down to specific markets, I mean, again, that sort of covers interest rates. We hit that 2.4 level on the 10-year. We've actually come up about 20 basis points since then. Potential bottom being carved out there. We'll have to see if it sticks. Meanwhile, the euro currency has been a disaster for the last month and a half, or last several weeks, which is sort of fits with the story that I had there. I said that I thought the euro was topping and was going to roll over. It's ever since that Draghi day where we almost hit 140, the euro's been falling. This morning it's down another almost half a cent or whatever against the dollar. We're at about 135. 40 here, and I think it'll be interesting to see if we can undercut 135. I think we got a couple cents down on the euro beyond there, because I think that we're in a different scenario. The U.S. is, not tightening, but it is tapering, and I think that select members on the Fed are getting much more vocal about the lack of volatility and the increase of risk. The economic data, we just had a stretch of 200,000 plus job creation in the U.S. For the 4th month in a row. That hasn't happened since 1999. So what the hell is everybody worried about, the economy falling apart, and why are interest rates at 0? It doesn't make any sense. The economy's not booming, but we have no business whatsoever to be doing the kind of printing and QE and interest rate policy that's out there now, given the economic data. I think the U.S. Fed is trying to kind of extricate itself from that environment, whereas the ECB is at the complete other end of the spectrum and looking to, bury themselves under the QE bus, QE dirt as well. So in that environment, again, I think you still want to be short euro against the dollar. I think interest rates probably go up, but it's hard getting in front of that given, the other global pressures I talked about. And I think that you have to be getting more nervous as a stock investor. You don't want to be going all short here. But, taking some profits on off the table, lightening up, getting less aggressive with new purchases. I mean, I think those kinds of things make a little bit, a lot of sense here, just given this high wire act we have in the market.
Okay.
So that's all.
Makes sense. Thanks for the comments.
Yep.
Let's see, Doug Davenport, I know you follow the market trends pretty closely, and there's an interesting one about to begin. The World Cup kicks off in Brazil this week. Will that be good for emerging markets?
Well, the are certainly on fire, for lack of a better word, because if you look at the emerging markets, it's a new high for the EEM, the emerging market ETF. And India, to me, looks like the most attractive of the emerging market stocks out there. Russia, still very attractive even at these levels, I think. Taiwan, Spain, Germany. In fact, Germany's like the U.S. It just broke out in January out of a 13-year basing pattern. So Germany looks attractive even right now. But let me get back to the U.S. equity market, which seems to be on everyone's mind. To me, the short, intermediate, long-term trend's still up. The only negative is that, to me, that little bump, but that's not a bad problem to have. Technicals, once again, what I use, they show me the way by providing, very early and frequent indications that this market rally will continue this year. And the S&P's been up 13 of the last 16 days, and we've had 19th record high of the S&P this year. Back in December, when we all met there in your offices, we all had to talk about what our single bill was. Well, mine at the time was showing a chart that showed the breakout of the S&P over the last 13 years since 2000. It actually was a basing pattern for the S&P, in my opinion, and it broke out in January. And so we broke out of that 13-year basing period, so why can't this market continue to go up? I said that I felt like the S&P would surprise on the upside for 2014, and it certainly has right now after a little congestion there in the first months of the year. I noticed that Merrill Lynch is predicting 2,000 for a year-end target, and I think Deutsche Bank has 850. I don't know where they came up with that number. They could be right, but I don't believe so. The long-term channel from 2009 on the daily pattern, you can look at it, even the weekly, doesn't matter, monthly, they're all still trending up. The trend is your friend is the great word, great phrase. If you look shorter term, I talked about targets of 1928 and 1948 on the S&P for the last couple of weeks. Well, those both have been reached. The next target now is 1980 on the S&P. That comes from an inverse head and shoulders pattern that started with 1897 as a high and 1814 as a low. If you go back and look at a chart, factor that out, it comes. We do have a gap from last Friday at 1940 on the S&P that will have to be filled. That could be today. I see where the future is down a little bit, but I'm not worried about that. If you really want to see a bullish chart, go look up Intel. Intel just broke out of a 14-year basing pattern and just now reached a 13-year high. Now, there's a bullish chart. You talk about some stocks being in a bubble. Well, Intel's not. They're moving into mobile applications, and so Intel, I think it's very interesting to look at that chart. A 14-year basing pattern is now broken through its resistance line. So bottom line to me on the equity market is that we've been in this trading range for the S&P and Dow for several months, but you've had significant pullbacks in the Russell and the NASDAQ. And to me, the markets are back to full rally mode, and each of the four major indexes right now all have bullish technical setup patterns targeting higher prices. And most of, if you look at the big institutional and hedge fund, they're being forced to invest after a lot of people have been calling market tops all through winter and early spring. We talked about emerging markets. Gold, to me, there's a lot of congestion in here between 1250 and 1280 price range. It's just hard to get bullish unless you get to 1300 on gold. Otherwise, everything else is just short-term trading opportunities and short covering, I think, by most people. So it's just not attractive to most people out there right now, or at least the institutions and hedge funds, which are not in the commodity trades right now. It's just not attractive to go into that area. And you put gold in there too, because you've got no inflation concerns by the institutional accounts worrying about that in the future, or hedge funds, so they're not buying gold. And why not? Why not buy stocks instead of gold right now? Maybe that's what they're thinking. Back to the euro and treasuries, I wonder about Draghi's decision to create these negative interest rates. I just wonder whether that's like bringing a butter knife to a gunfight. You know, you can have these negative 1/10 of 1% or 1/10 of 1% interest rates. Maybe that's too small a tax to alter the bank lending in that region. I don't know. However, the euro is declining primarily because the U.S. dollar is rising, and the dollar is rising because interest rates have gone from 2.4 up to 2.61 now, or 2.63. So the euro can decline because the dollar is rising, and the yen could easily get back to 105. And who knows, maybe people are using the euro now for a carry trade, because if you've got to borrow the euro and sell short, if you've got negative interest rates on the euro, maybe the euro is going to replace the yen as the carry trade going for this next year or so. And crude oil, it's getting close to 105, which I've talked about in my commentary, is that could be a triple top for this year, or it's going to be a breakout at 105 and go to 110, 111, 112. So gold and crude oil have had the same triangular technical pattern going back for several months now. Gold broke down, oil may break up. It's hard to say. You can't tell until it actually happens. So that's what I see right now.
Okay, Doug, thanks for that whirlwind tour of all the different markets. Let's see, Larry McMillan, are you on the call this morning?
Right. What Doug said, I just agree with pretty much everything. I can offer a little bit different viewpoint on some of it, but, you know, as far as what he was talking about, the breakout on the charts, I mean, that's, you know, a fact. And the funniest thing is, it doesn't really seem to have generated a lot of new bullish sentiment, which is, of course, in itself bullish. Our put-call ratios are still in full buy mode, and they're not overbought yet. So looks to me like, you know, people are not really jumping on this thing and buying a lot of calls. Obviously, we're buying more calls than puts now, but not to the extreme that would generate a sell signal. Also, with volatility, I mean, you know, VIX is very low. In fact, the short-term VIX actually closed below 10 the other day. Actually closed well below 10, which is an all-time low for it, although it only goes back a few years. VIX itself closed below 11, but I think I mentioned last week, back in 05 when VIX did the same sort of thing, closed below 11, the market went up for a year and a half before it really broke. So just because VIX is this low doesn't necessarily mean the market's going to have a big problem right away. If it went below 10, you know, then I would say that probably is a short-term sell signal. But again, just sort of short-term. You've got new all-time highs in the New York Stock Exchange Advanced Decline line, and we also follow another measure, which is all optionable stocks. The Advanced Decline line there is also a new all-time high. So, you know, all of these things, plus the fact that my general feeling, if you watch TV very much, is that you're not really seeing that many bulls out there. Everybody's talking about, you know, how the economy doesn't justify the market and all those sorts of things, and rather than just you know, following the trend. Obviously, we're right now above the what I call the modified Bollinger Bands on the upside, so it's a little bit stretched just from that point of view. But I would not think any pullback would go below the recent breakout level of 1900 on S&P. If I was to pull back to 1900 and then started up again, that would be you know another classic bullish move. So. Yeah, I'm bullish too.
Okay. Well, thank you for those thoughts. I appreciate it, Larry. And that pretty much wraps it up for this week. I appreciate everyone calling in and sharing your thoughts and insights. And same time again next week. I look forward to it.